Let's first unpack why we're sensing something significant might be about to unfold. Market uncertainty is at an all-time high right now. We're looking at the possibility of a military response from Israel toward Iran, specifically targeting their new nuclear facilities. Meanwhile, President Biden is urging a measured approach, favoring sanctions over direct conflict, especially with elections on the horizon. His administration is keen to avoid appearing aggressive, given his previous warmongering reputation, which complicates the situation further. Adding to this tension is the looming threat of a port strike. The Biden administration is pushing for negotiations, trying to ensure that workers receive fair compensation to prevent disruption. This is crucial not just for the economy but also for securing union support as we approach the election. Both these issues contribute to an environment ripe with uncertainty. If Israel proceeds with a strike, we could see a spike in oil prices. In recent days, prices surged by 5% one day and 4% the next. However, after Biden called for calm, prices slightly retreated. The concern is that rising oil prices lead to higher inflation, a topic we'll explore shortly. The potential port strike also poses risks. While it might lower oil prices temporarily due to ships being idle and not consuming fuel, it could create severe supply chain issues, ultimately pushing inflation higher as shipping costs rise. Now, the key question is, how long will this uncertainty persist? The issues involving the Red Sea and Israel have been brewing since last October, while the port strike dynamics became apparent back in June. This long-standing awareness of these issues has already affected economic performance, with signs of strain emerging earlier in the year. Interestingly, despite these challenges, there are some glimmers of hope. Recent reports show improvements in job openings and retail sales, which raises the question. Are these indicators of a genuine recovery, or are they temporary blips due to preemptive actions taken ahead of the anticipated port strike? We should also pay attention to the bond market, which is behaving in a peculiar manner. Following the Federal Reserve's recent surprise rate cut, we've seen an increase in 10-year Treasury yields, a sign that financial conditions are tightening. This rise might be linked to inflation fears and uncertainties surrounding the Middle East. Inflation expectations, which had been low, are now creeping up again. This change signals that something significant could be on the way. Historically, when bond volatility drops to these levels, it typically precedes a major market shift, whether up or down. We've seen this pattern before, notably during the Great Bond Short in October 2023 and again in April 2024, both times when low volatility was followed by significant movements in the market. Given the current climate, we can expect something to break soon, though it's hard to say whether that will be positive or negative. We have a slew of critical earnings reports, job data, and economic indicators approaching, all of which could dramatically influence the narrative. If the port strike is resolved and geopolitical tensions ease, markets might stabilize and potentially rally. However, with so many interwoven factors at play, it's crucial to stay vigilant. To wrap up, keep an eye on the upcoming earnings and economic reports. They will likely shape the market landscape moving forward. With the potential for bond yields to drop significantly, we are in a pivotal moment.